Driving isn't about hitting the gas. It's about making constant decisions. Should you take the highway or the scenic route? Is it worth stopping for gas now, or can you push on to the next station? Should you pay for the premium fuel, or is regular good enough? Each decision involves costs, benefits, and trade-offs. Businesses operate the same way. Every day, companies face critical financial decisions. Should they accept a discounted bulk order? Should they manufacture in-house or outsource? Should they discontinue a product or reposition it? The answer isn't always obvious, and that's where marginal analysis comes in, helping businesses navigate trade-offs and drive profitability. Let's talk about the special order dilemma. Imagine you're the CFO of a sneaker manufacturing company. A major retailer approaches you with a special order, 100,000 pairs of sneakers, but at a 30% discount off your regular price. Should you accept this special order? Now, if the factory has excess capacity, the only relevant cost for you would be the variable cost per unit. If the offer covers those variable costs and adds a margin, you make the deal. But if the factory is at full capacity, fulfilling the special order means losing high margin direct sales. The opportunity cost may be too high, and you may actually say no. Another example, let's say Tesla. Constantly evaluates whether to allocate battery production to high-end models which have higher margins or lower cost models which have higher volumes. Now, marginal analysis ensures that Tesla optimizes revenue at any given point in time. Now let's indulge in the outsourcing debate. Make or buy. Should a company manufacture in-house or outsource production? A very critical business decision. And let's take the case study of Apple, which is a master of strategic outsourcing. Keeping high value design and innovation in-house.
I think knowing the culture of Apple, their inherent design focus to control as much of the stack.
While outsourcing capital-intensive manufacturing. Chip designs are done in-house by Apple.
I think one of the most, if not the most profound change at Apple, certainly in our products over the last 20 years, is how we now do so many of those technologies in-house.
Which designs its own M series chips for the Macs and A series chips for iPhones to differentiate from competitors.
In a major shift for the semi industry, Apple turned away from using Intel's PC processors in 2020, switching to its own M1 chip inside the MacBook Air and other Macs.
But the chip manufacturing is outsourced. So instead of building costly semiconductor factories, Apple simply outsources chip production.
All its most advanced silicon is manufactured by one player, Taiwan Semiconductor Manufacturing Company.
However, Apple doesn't stop at chips. It also outsources iPhone manufacturing while retaining control over product design and user experience. Why? Now, setting up its own manufacturing plants would be far too expensive.
It's going to take time and a lot of money.
And a lot of expertise, all of which takes years to develop.
3 to 5 years, depending on the product, to put that in place at the scale and quality we need in the US.
While outsourcing allows Apple to scale production, reduce labor costs, and maintain flexibility in supply chain management.
It's cheaper and more efficient to manufacture in China.
China stopped being the low labor cost country many years ago. And that is not the reason to come to China from a supply point of view. The reason is because of the skill and the quantity of skill in one location.
To the contrary, we've got Tesla, which is one of the most vertically integrated automakers. Besides assembling its own vehicles like other automakers, Tesla also produces battery cells, AI chips, and even car seats, a stark contrast to traditional automakers that rely on third-party suppliers. Now, by manufacturing high-cost, high-value components in-house, Tesla reduces production costs, controls quality, and mitigates supply chain risks. For example, while competitors struggle with the global chip shortage,
a global chip shortage is pinching them hard.
In the first quarter, you may suffer an impact from the chip shortage of $1 billion to $2.5 billion this year.
What this study shows is that the chip crisis is really far from over.
Tesla's ability to rewrite software and use alternative chips kept production running smoothly. Next, let's talk about the decision to continue or to discontinue a product line. Let's take the case of General Motors. For decades, sedans dominated the US auto market. But as consumer preferences shifted to SUVs and trucks, GM had to decide, should they keep producing sedans despite declining sales?
We've got the Q1 numbers from General Motors, a bigger than expected decline in terms of total sales, falling 7.1% in the first quarter.
Or should they reallocate production capacity to higher margin SUVs and electronic vehicles? GM assessed fixed versus variable costs. Sedans had lower margins than SUVs and trucks. Also, SUVs and electric vehicles had higher consumer demand and long-term growth potential.
What the electric vehicle and what connected vehicles are going to do for us is increase the revenue opportunities for us over the life of that vehicle.
Marginal profitability analysis showed that discontinuing sedans would free up capacity for higher margin models. The result? GM discontinued iconic sedan models, shifting production to SUVs, electronic vehicles, and trucks. Now let's talk about pricing decisions. Let's take the example of Gillette, which doesn't make most of its money selling razors. Instead, its business model is based on selling razors at a low or even break-even price, sometimes at a loss, and making high margin profits from blade replacements. This is known as a razor and blade model. Similar to how printers are cheap, but ink cartridges are expensive. Gaming consoles are affordable, but game sales, they drive profits. Now the CPA's role here is to analyze whether a loss leader strategy is sustainable. And you got to ensure long-term profitability from recurring sales. In the business world, every decision has a cost. And a CPA's expertise ensures companies make profitable choices. Marginal analysis isn't about cutting costs. It's about optimizing resources, pricing smartly, and knowing when to pivot. CPAs don't just analyze numbers. They shape the financial future of businesses.